Thank you for joining the CCIM New York Metro webinar. We're going to be starting momentarily. Good morning. My name is Lee Barnes, and I am the 2024 CCIM New York Metro President. And we thank you for attending the CCIM New York Metro webinar's State of the CRE Market. The CCIM Institute and our chapter's mission is to elevate our members to the highest level of success through technology, education, and networking. The CCIM Institute was established in 1967, offering the finest education and tools. The CCIM members spans more than 30 countries around the world, with 59 chapters across the globe, offering additional networking, deal-making, and educational opportunities. 47% of the CCIM Institute membership are made up of brokers. The remaining 53% include investors, developers, consultants, property managers, corporate real estate executives, appraisers, lenders, bankers, and others. The CCIM Institute administers a CCIM designation, which is considered the professional standard of commercial real estate. Only 10% of CRE professionals hold this designation, which consists of completing a rigorous curriculum, including core courses in financial analysis, market analysis, user decision analysis, investment analysis, negotiating training, an ethics course, and the comprehensive exam. The New York Metro chapter is looking to expand our membership, and we would be happy to answer any questions you may have. We would also like to add that for a nominal cost of $99, we will give you an annual membership, which will provide ongoing support to our chapter to do events, including both educational and networking events. Please feel free to reach out to me or any of the panelists for any further questions. At this time, I'm going to turn it over to our keynote speaker, Camille Renshaw, CCIM, so we can get started with our webinar. Hi, Camille. Thanks so much for joining today. We appreciate you being here.
Good morning, Lee. Thanks for having me.
Absolutely.
I love my fellow CCIMs, and I'm always happy to talk with you guys.
Camille, what company are you currently with? What product type and markets do you specialize in?
Great question. I am CEO of a company called B+E. We specialize in net lease brokerage sales. A lot of folks think of us as a technology company because we do have so much data and tech behind what we do. But at the end of the day, we're really just a brokerage firm. We have offices in 9 cities nationwide. We're US-based only. We only do investment sales, which most CCIMs should appreciate. So, I am also a founder of a very small fund, and I do want to make sure I mention that on the call today, because I feel like I owe a lot of CCIMs a debt on this of help and advice and counsel. It's called Artemis Bow. There are 4 female founders, and I have great people like Gene Trowbridge, who have, he's worked on our legal. Some of you may have taken classes from him before. We have a few CCIMs who have become LPs in the fund, and we're out buying car washes. It's a very small fund. It's like a $20 million fund, but it's not the main thing that I do by any means, but I just wanted to make sure I gave some kudos to CCIM for that. So happy to talk with you guys about the net lease market. We're seeing quite a bit change year over year right now. So forgive me that I don't have slides to share with you and the audience today, but I am going to run through some stats. Again, it's been a fairly dramatic shift year over year, so try to help ask some questions at the end if I go through the numbers too quickly. This is all B+E data. The net lease volume, again, we specialize in net lease transactions, the net lease volume year over year fell about 49%. Very dramatic. It was 79 billion at the end of 2022 and 40.3 billion at the end of this last year. And I would say we're probably seeing even lower quarterly transaction that hasn't quite tied out and been measured here at the end of March. It's just definitely on a downward swing. I would say relative to other asset classes, we're doing really well. Which seems funny to say, but it is still dramatic, and I want to make sure that I emphasize that in this call. The industrial and logistics share of net lease, that has been shifting now for a few years, and I think it's a big part of the story that's happening with net lease right now. It's increased to 51% year over year from 43% a year ago. And it was in the 30s before that. Like, it's just really come up to take up about half of what we think of as net lease. Retail had dropped, especially right before COVID. And it is now increased to 51% from, increased to 30% from 26% year over year. No surprise to anybody in here, office has fallen from 31% to 19%. Do keep in mind that includes medical office, which people are condemning the office story constantly, but forget that medical office is still doing fairly well. But I would say that, as I say, 19% of transaction volume right now is office. It's probably even lower right now. I wouldn't be surprised if it was in the single digits. Honestly, I'm seeing almost no office transactions at the moment. The average net lease cap rate story is interesting. As many of us talk with our teams or talk with our clients, it's interesting how little it has moved in net lease. It has increased 70 basis points year over year and is currently about 6.5%. So again, moving from about 5.8%, where it had hovered around 6% for a really, really long time. That blends in all types of net lease transactions. So obviously, some transactions were occurring even in the threes. Those have moved up. Generally, those didn't require any debt, though. The increased mortgage rate and the elevated 10-year treasury surprises no one on this call. That's the story, right? But so little comes on the market in net lease during a crisis, that unless it really has to be sold or transacted at that moment. So what happens is supply just decreases so substantially during things like the Great Recession or the moment we're going through now. The cap rates just don't move that much. There's still a lot of family office activity, which I'll get to a little bit more in a moment. And that obviously doesn't require as much debt. It's either low leverage or no leverage. And so again, the debt constant isn't influencing the cap rate in quite the same way. No surprise to anybody, but I have to say, after yesterday's meeting, the U.S. 10-year Treasury has risen 400 basis points or more since the mid 2020 crisis. Currently, it's at, or was a few minutes ago, 4.277. The story yesterday is that the 3 rate cuts for this year are still on the table. Now, the central bank, keeping that in its forecast yesterday is huge, and I'm really happy about it. I will tell you, and many of you may have had these text messages too, we all started lighting each other up like, yes, can we have a 75 basis point rate cut this year? The thing that I had to tell some of the younger people in our organization is there is no mandate for each of those to be any amount of basis points, right? We're all expecting each one to be 25 basis points. It would seem dramatic if it was more than that, but it could be anything, and it could be nothing, right? It also could have no influence on mortgage rates. So we're all just kind of waiting to see where that story goes. But I will say generally, and other major companies in the space, CBRE, JLL, et cetera, are all forecasting some version of the second half of the year is when we see things really stabilize, and transaction volume will just kind of get back on a more regular pace. I think we especially expect that. We think Q4 will be huge for net lease. Q4 is always bigger for net lease, right? With all the tax motivations behind the space. So we think, we're guessing. I want to emphasize guessing that fourth quarter will be about 25 billion in net lease sales. Now, let me go back to the top and say, last year we only had 40 billion roughly, and that was a 51% drop. So 25 billion in Q4 would be huge, but annualized it might look really similar as this quarter is so weak. I would say, the story for net lease about where transactions come from, it comes from multiple places, but the big buckets are 1031 exchanges, which many of you are active on. Those, though, in net lease in particular, often we estimate about half the time come from multifamily. So as all of you are seeing a massive slowdown in 1031 activity, just look at the multifamily space. My partner, Scott Skurridge, was on that huge apartment team that Cushman has in his 20s. That's kind of where he cut his teeth in multifamily. So we're always calling that Cushman team and asking them, like, what is going on in the Southeast? I think they're the biggest team in the country. What is happening with apartments? And the story is things are going to be slow for a little while. Rents are dropping. Interest rates aren't helping. There's a massive pipeline of construction. So supply is not limited. So all those things are going to tamp down transaction volume and 1031 exchanges. But I would say that we see about 45% of the sales coming from non-1031 exchange activity. And right now, that's primarily private buyers and family offices. As I have been able to brag about our team at B&E, that we were only last year down about 25% year over year. No leader loves to brag about being down 25% year over year, but I saw these abysmal stories out of other brokerage firms. I do think we have incredibly talented people, and I think that our tech is very, very sticky, both for the client and the broker. But I think a lot of it is our emphasis on family offices. The family offices are still very, very active, and they have generational needs to do transactions. People aging in, aging out. They have just tax plans they're trying to execute. That is not always controlled as much by exactly what the mortgage rate is at that particular moment. So those transactions have continued. I will say at the moment, I have no data on this. At the moment, what we are feeling, and many of you may be feeling, are the institutions start to step back in. They're getting a sense of what I was talking about. There's some stability. There's some game plan. There's some expectation of how 2024, 2025 can go, how those plans can be executed. I will say, given the dividends many of them pay, especially in our space, those cap rates they want to pay are, start in the 7s. Obviously, they're thrilled if they're in the 9s. We completed last night a middle market transaction with one of the large portfolio with one of the large net lease REITs, and it was about an 8 cap that we completed last night. And it's a sale leaseback, all the bells and whistles other than, probably middle market credit. So that's the only problem that we're seeing in terms of where cap rates might go, is they may go up a little bit as the institutions get more involved. But we're thrilled to have the volume, right? That they've raised capital. They have a lot of things they can add to the market in terms of great execution, getting some volume on the books this year. I think the piece to say here in close that I have in my notes is you as CCIMs know this, data is key. A few of the things that I shared today, I couldn't put in a slide, which is why I didn't give you guys a slide. I feel like it's very moment to moment. We all need to be talking and communicating with each other. Relationships are going to take you through this cycle, take you through the next cycle, and talking to each other and hearing what's going on. Ian Gruce over at 10X may have a very, very different story than Alfonso or somebody who maybe is in in a more added value component of the market or in New York City, etc. Like we all have different versions of this, right? So we need to be talking with each other. And then the final things, there are huge opportunities. Right now is when careers are made and when a lot of capital is made. But you do have to be thoughtful about that. First of all, as a, for some of the younger people on the call, if you are thinking how do I build on this crisis into a career? I just want you to know I have people that work for me who are in their early 30s. This is really their first full market cycle. This is how you learn to be a great advisor to your team members, to your shareholders, and certainly if you're a broker, to the clients, right? Nobody totally trusts you unless you've seen a full market cycle and what can go wrong. So ask a lot of questions, try and be in every meeting, every deal you can be, even if it doesn't make you money. It will make you money later. And then to the entrepreneurs here who are really thinking, how do I invest? I started the call with, I teamed together with a bunch of female founders to try and go invest in car washes and take advantage of some of these cap rates. I encourage a lot of you to do that. There's a ton of capital on the sidelines. And if you're looking to have a small fund or to even just buy that apartment complex that maybe nobody wants to buy, that's outside my space, but whatever you guys want to do where you feel like you can add value for shareholders, ask people on this call what they've done. Seek out other folks who've had that experience. Relationship skills and experience are what ultimately create money. Don't get distracted by not making as much money in 2024. You'll build your career and you'll build a lot of value for your shareholders this year, and you'll see it in years to come. Lee, I don't know if you want to have questions now or you want to wait till the end, but that's what I had to share.
Thanks, Camille. Yeah, we're gonna wait till the end for the questions. And thanks so much. That was super informative. Amazing job. I am now going to introduce Ian Grusd, our moderator. Ian is the past president of CCIM Metro and the national director with 10X. Ian?
Thanks so much, Lee. Really excited to be here and hear from our CCIM experts on various asset classes in the metro area. Just briefly, 10X is the largest online live bid transaction platform. We've been selling real estate online since 2009. We've sold over $30 billion of properties. Our average deal size is in the $3 to $5 million space. And I'm a proud CCIM for more than 25 years and really appreciate Camille not only sharing insight on net lease, but also career advice. Some of the best advice I've received has been from my peer set within the CCIM community. So I really encourage you to explore CCIM education as well as the CCIM Metro chapter. What I'm really looking forward to today is we have no pie charts, we have no graphs, we have no slides. We just have real insight from trusted advisors in their area of specialty. So we're going to kick it off with introductions. Brian Whitmer, if you could tell us what company you're with, the product type and market that you focus on.
You bet. Thank you, Ian. So I'm the founder and managing partner of RE PropCo. After 20 years of being a partner in the investment sales group of Cushman & Wakefield, covering the tri-state, New Jersey, New York, and Connecticut, I started RE PropCo to acquire apartments as well as develop small bay industrial. Excellent. And continue to do advisory work on the brokerage side.
Great. Matt, if you could share who you're with, what product type and markets you focus on.
Yeah, sure. Happy to do so. Hey, everyone. How's it going? My name is Matt Annabelle. I'm the Senior Director of Acquisitions at First National Realty Partners. First National Realty Partners, or FNRP, is a owner and operator of primarily grocery-anchored shopping centers across the country. Our portfolio consists of over 60 properties, which is over 12 million square feet, and total AUM exceeding $2 billion. Over the past 24 months, we've been exceptionally active, having acquired over $1 billion in new deals, and we're always looking for new opportunities to grow our portfolio and create value for our investors.
Awesome. Thanks, Matt. Switching over to my friend Chris in New Jersey. Chris.
Ian, thanks. Hello, Chris Cervelli, principal in Cervelli Real Estate and Property Management. We are a property brokerage and property management firm, primarily specializing in multifamily in northern New Jersey.
Thanks so much, Chris. And JR, tell us a little about yourself and what you focus on.
Thank you, Ian. J.R. Chantenko, Managing Director of Blackpool Investments. We are a commercial lender. We also have a fund that we manage. One of the unique things we're doing right now is a private credit facility, and is agnostic to any of the commercial real estate asset classes that we lend in. We focus nationwide, but can also do some global projects as well. If you have other projects outside of the United States, we look at all asset classes. Thank you.
Thanks, JR. So just building on what Camille spoke about on net lease, obviously capital markets really dictates the pulse of what's going on. So Brian, please share with us current market conditions and what you're specifically seeing.
I'm going to continue on what Camille said, and I think there's a lot of psychology that is wrapped up in the interest rate movements in the Feds. As I'm going to go back to the beginning of the year, being at the National Multifamily Housing Conference, and it was during one of the Fed meetings, and the sentiment coming into it was very positive. Everybody in real estate was hoping and expecting that there was going to be a decrease in the Fed rates. And why was that important? I think everyone felt that that is the sign that the valuations in the markets, call it cap rates, are going to be stable to decreasing. And at that point in time, the capital, especially institutional capital, is going to come off the sidelines, start to buy, which will then create more transparency into valuations. And the snowball starts to roll down the hill and get bigger after being a very stagnant market starting back in mid-22 at the infancy of the rates rise. And when the Fed chose to hold the rate, it was palpable. You could really feel some air come out of the room, and everybody said, look, we don't think that values will go down, but for the time being, everyone's going to continue to sit on their hands because nobody has true conviction to go out and sell or buy because of the very limited data that had been set over mid to late 23, which my view is we saw the bottom of the market in the valuations, because at that point rates had continued to keep rising, and those who had to sell or transact did so because they were either forced or they had felt trapped in that interest rates could get worse. So I think that we are at an inflection point of a period of which the capital markets will return to some normalcy. You will see all different types of capital, from the family offices up through professional equity, the raised funds, and then into the the JP Morgans and the Invescos and the larger fiduciaries, all returning. They all have capital. They're all keeping abreast on what's going on, but it takes one or two sales to then get everybody to come back into the market. So look, and I'll end with this, which is, when the Fed does, and hopefully they will, decrease the rate, I think everybody, prepare for that and take advantage of it and continue to prep for it.
Awesome. Thanks for that. During this transitionary market, one of the shining stars, especially in comparison to the COVID times, is retail. So Matt, really interested to hear what you're seeing going on in the retail market, what trends and really any new concepts opening during this time.
Yeah, sure. So as Camille and Brian touched on, obviously rates are at the forefront of everyone's mind, and rising interest rates have led to decreased prices, and deal flow has certainly slowed down as of late, and not quite where we were hoping it would be at this point in 2024. So from an acquisitions perspective, it's certainly been a challenging start to the year. Deals seem fewer and farther between, and marketed opportunities that we come across that we've been interested in pursuing have been incredibly competitive. Certainly seems to be a lot of equity on the sidelines, eager to be invested. And the larger challenge, at least for us, remains sourcing debt at favorable terms that allow us to be competitive on deals. Now, from a leasing perspective, I think the retail market has been incredibly strong, and rising interest rates and rising construction costs have limited new development, which makes it difficult for tenants to, get up and relocate out of our centers. Our portfolio occupancy currently sits in the mid-90s, which is right around the national average. I believe last time I checked, it's around 4.5% vacancy across the country, which is very strong for retail. And we are fortunate to report that in 2023, our renewal rate for existing tenants that were renewing in place was a 10% increase over the prior rent. And even more impressive, I think, and just kudos to our leasing team, is that for new leases, backfilling tenants who vacated in 2023, we reported 31% higher rents than the prior tenants that had left the spaces. So the retail market, or the retail leasing market, remains incredibly competitive and strong. Our portfolio occupancy is very strong. Now, that's a double-edged sword. I sit on the acquisitions team. So what that means for me is, a lot of our competitors are witnessing the same leasing momentum. A lot of the deals that we're seeing are fully leased, fully stabilized. There's a lot fewer distressed assets on the market, fewer opportunities for value add deals. Most of what we're seeing is stabilized, which makes it a lot more challenging to generate, the IRRs we need for our investors.
That's great. So with all this leasing activity, and we've also seen a couple of retailers impacted, and maybe they just haven't adjusted to current times with some big box vacancy. I think of like Bed Bath and Beyond. I don't know if they were in your portfolio, but who are you seeing interest and activity in terms of retail concepts, and anyone taking larger blocks of space?
Yeah, so primarily we try to invest in neighborhood and community grocery anchored strip shopping centers. Now, we do have some boxes in our portfolio too, of course. We found that in the shop tenant space, the most active tenants right now continue to be the medical users. So dentists, dermatologists, urgent cares. We've been doing a ton of business in the medical space. QSRs remain active. A few tenants, Chipotle, Chick-fil-A. We're doing a couple Wingstop deals right now. As you get bigger, it certainly gets a little bit more difficult. The junior box space, we found that, Five Below remains active. Hibbett Sports is active. Brands or tenants like Burlington, TJ, Ross are all, looking for that 20,000 square foot footprint, where in the past they, wanted larger, up to 90,000 square foot spaces for Burlington as an example. So we found that the 20,000 square foot space has actually been pretty competitive as well. And then in terms of larger spaces, so our big box, our anchors, entertainment remains pretty active. So we've done, a deal recently with a tenant called Fun Zone, which, I'm sure you're all familiar with the concept, kids kind of amusement park, and air parks such as Urban Air remain pretty active. And then now our newest concept, which we're pretty excited to open up later this year, is going to be our first pickleball. Ace Pickleball is opening in Voorhees, New Jersey, and I'm sure everyone on this call has heard about all the buzz with pickleball. But the biggest hurdle, I'd say, in any of these entertainment concepts is ceiling heights, and a lot of these boxes that are being repurposed might be older and don't necessarily, have the 18-foot high ceiling heights that pickleball and, Urban Air require. So that's something we always have to be, aware of. And then the last comment I'd make, you mentioned Bed Bath and Beyond, and, we've recently heard the news of Joann and Family Dollar. Joann's filing for bankruptcy. Family Dollar announced they're closing 1,000 locations. It sounds like it's primarily going to be the poor performing stores, many stores that they probably would have been looking to close, anyway, out of their, I think, 16,000 combined Family Dollar and Dollar Trees. We found that a lot of those leases, and we have FNRP, we have very limited exposure to any of those tenants, but the ones that we do, we find that those leases are generally older with below market rents. And our leasing team is already fielding calls for potential backfills in the event that those tenants do in fact leave our centers. So we actually feel pretty optimistic, and we think it'll be an opportunity to create value for our investors.
Awesome. And it's interesting to me that you're getting activity from medical related businesses. I think the perfect thing to do is put a physical therapist and a chiropractor next to the pickleball facility. You know, they'll be extremely busy. You know, I'd like to invest in that. So we'll move over to multifamily. Chris, tell us what's going on.
Hey, Ian. Yeah, so Northern New Jersey, tri-state area, still, critical mass of people, very strong demand. But we are currently starting to deal with a heightened supply in certain pockets. The region at vacancy rate is about 2.5%. If you shift over to Northern New Jersey, that's going to be closer to 5%. We have absorption levels that are down for the second straight year. And a lot of that has to do with the pipelines that were built. Post financial crisis, that time, say Journal Square, that came out with their 2060 redevelopment plan, and they were really driving developers to build along rail lines and in urban cores. And look, everybody was very excited about that. And then when the pandemic hit, obviously the story of office and retail was known, but there was an element of the residential component now that realizes if they can work from home, they don't need to be on the train station. They're looking for better value. And so what we're experiencing right now is a lot of competition for these tenants in those places there with a lot of concentration and saturation of product. Conversely, if you go out to the suburbs, there's a lot of demand from tenants and investors for this product because, first of all, from the tenant's perspective, you're going to get better value. But from an investor's perspective, if you're going to invest in a urban building with, fully baked in rents, you're going to get your inflation bumps, but you're not going to get that real value add that you would say in the suburbs where you're maybe in a rent control product. They weren't getting a lot of attention during the pandemic, right? And so, look, it's going to be a tough sledding for a little bit. Vacancy rates are probably going to elevate to about 6% in Northern New Jersey, and rent growth is probably going to dip to about 3%. That's on an average level, though, again, because we're still seeing in those suburban areas rent growth actually at double-digit numbers, right? Depending on how much value could be added. And that's where we're seeing a lot of the activity from investors as well. They want to buy in those neighborhoods that have upside, and they're willing to pay for it because, right now, and, we'll get to this more later on, but, rates affecting what people can do in the coupon clipper type of product, it's going to be tough sledding for a couple of years.
Thanks so much. Turning it over to JR and financing, which is the fuel which moves the CRE vehicle. So such an important component. We've heard that multiple times. So let us know what you're seeing in the finance markets.
Thank you very much, Ian. What's interesting, I came into this market, how Camille mentioned that, for sort of the new people coming into the business, I came in back in late 89, 90. So I'm dating myself, guys. All right. I'm probably the oldest guy in the room here. I'm 60 years old, and I've seen, basically almost 4 market cycles. So if I could tell you anything, this is the place to make money is right now. And you may have to dig a little deeper, but this is the place to make it. What I'm seeing now is getting really more creative in deals. We're seeing bank deals. We are seeing distressed deals where we're financing note-on-note financing in conjunction with additional money that needs to finish a project. We're seeing a lot of what happened during post-COVID times. Projects that were being built have stalled out. where now a builder is in default. He can't get any other money. None of the investors want to put any money in a deal. And so he's left to do something else. He's got to restructure. So I've seen probably six deals in the last 6 months, all on restructuring that we're involved in. There are majority are multifamily. We've seen a few hospitality and a few mixed use projects, and most of what I'm seeing are workout scenarios. And having come in back in the 90s when RTC was created, I did most of my business with RTC at the time as a capital advisor. And what brought me to New York was the same thing. I was hired by the FDIC to do a very similar workout with a large CMBS portfolio, which was the Bear Stearns Lehman Brothers CMBS portfolio. That's what brought me to New York originally, almost 15 years ago. And I'm still here to this day. All I can tell you is you have to be resilient. Financing is so difficult because rates have gone up, doubled in the last 2.5 years. Everyone talked about it. It's the big elephant in the room. What's going to happen now? We hear the FOMC potentially keeping rates flat for now, and potentially with a drop in the next maybe 2 or 3 drops this year. Even they said that. I don't know if that will help, but it is wishful thinking. But sometimes you got to live on a little hope. You got to have hope, and you have to have tenacity to work this market. All I can say is you got to go out there. You got to dig deep. You got to ascertain sellers and buyers' motivations. You got to see where are we at with basis. How do you make the numbers work? It's all about the returns, right? With playing with the rates that are almost nearly double what they were, almost 3 years ago. We are in definitely a different environment. Deals are getting done, but they're different kinds of deals. They're not your traditional origination deals in a nice, stable market. This is a market that's still, I believe, in many ways, still in flux. We don't know exactly where we're going with the market in many sectors. I've seen what I could tell you on the a bright hope is probably in the infrastructure, industrial real estate, and entertainment real estate. What I mean by entertainment, I'm talking about purpose real estate. We're dealing with a large publicly held company now. We're financing a project in Orlando, Florida. It's a entertainment park. Now, that's the weirdest thing, but the markets tell them that this is the market to be in right now. And we are one aspect of the financial tranche in this deal, adding about another $100 million. They need to fill a gap in completing their capital stack. So it's just getting really creative and doing those kind of deals. We are seeing a deal in northern Jersey. It's also a similar entertainment real estate space. You guys been hearing about Lionsgate and Amazon and them coming in and doing stuff in northern New Jersey. The governor just announced over almost 400 million in tax credits that are available to make that space very interesting. So along with tax credits, that's allowing these deals to drive the fuel to create the demand. There's a big need after COVID. People want to watch their Netflix. They want to watch all these shows. They need and all these distributors. They need content, and they need the locations to do it at. And right now, tax credits are driving that. So that's, I think, going to help a lot. We're seeing a deal in Texas. It's an industrial park where there's local subsidies being provided, and the Inflation Reduction Act is providing additional fuel to allow technology and that to be developed. It's about 1 million square feet. We're going to be financing the front end of a bridge loan. They need roughly about 85 million or so, and that will just get the infrastructure going for about 200, almost 270 acres. And we think that that's a really positive thing. They're taking advantage of that tax credits and layering that into the capital stack. So again, these are, transactions and deals that are happening. We're seeing really, really creative things that I would never seen, in previous years, but this is what I'm seeing in my marketplace now.
Yeah, great. And I love you talk about the tenacity, and something which I feel has really impacted all of us is for the commercial real estate individual to be a trusted advisor, not an order taker, not just listening to what the client is dictating, but really providing them with your insight and expertise. And the one specific area is the bid-ask spread. You know, something we have all seen and experienced is that buyers' expectations came down a lot faster than what sellers were holding to on pricing. And it was a combination of, hey, I saw what a colleague got or a competitor got in terms of pricing, cap rate, price per unit. That's the price I want. Or they were just numb to the fact that the market was changing very quickly. So I want to go back to the group, and I'll go to you, Brian, in terms of bid-ask spread. Are you starting to see movement? Because I feel a combination of that gap getting closer plus the fuel of finance is really what's going to get the market to kick back into gear.
Exactly right. And I think that looking back over the relatively near term, you can go back to the GFC in the 08 to 09, and we'd all been trained to wait and not accept the bid-ask spread because the buy side and the capital side moves very quick and is sensitive to debt, where on the sell side, you're still really looking in the rearview mirror, and that's what you're basing your decisions on. And everyone has benefited from holding, if you could, through a 2 or 3 year time span, the interest rates and the economy and the capital markets repair themselves, and values have returned to the historic highs and even exceeded it. So we came into a very supercharged time from mid 2020 through mid 2022, where the trees kept growing to the sky. And it was a very abrupt, very acute change in interest rates and how quickly that they increased, and how fast I would say that the buyers responded, and the sellers continued to hold their ground. That has been starting to shift as you've seen more, I would say, the private capital and the entrepreneurial capital that usually precedes in these type of situations to set the floor, to buy the opportunities that present themselves, while the more institutional capital watches, that is more dependent on a herd mentality, a safety, doing what the rest of the market is doing. And we're now where I would say that the private capital has an understanding of where interest rates are today. And here's where I'm going with this, and why I think that the bid-ask spread is closing, is that there is now predictability in that if I put a property under contract today, when I need to close on it in 90 or 120 days from now, I'm relatively certain of where my interest rate will be, or at least the high water will be. And once that starts to happen, you start to see more capital come in, you start to see people get more aggressive and build in less interest rate contingency. And then it just takes the seller side to come to the realization that if I want to transact in the current market climate, this is market. And I got to choose, do I want to be a seller or not? And we're sitting in that teeter-totter right now, where both buyer and seller barely have their toes on the ground, but they're starting to bounce back and forth to see where we go.
Right, yeah. And so switching over to retail, and Matt, you spoke earlier about a lot of competition for deals. So bid-ask spread, I would think, looks a little different in your space. What are you saying?
Yeah, so I think it's a little different now than when it was, when rates first started to hike, and, sellers had deals on the market and they weren't hitting their pricing. Now, I just think those sellers aren't listing their deals. I think there's an understanding where they're going to trade and what market value is, and there's just fewer opportunities for sellers to move their product. Now, the deals we see on the market generally are sellers that have to move it. Maybe their fund is closing, or debt is maturing, or whatever other reason they have to move it. So there are still opportunities out there, and there are a lot of buyers looking. So it's a little difficult to say, well, what's the bid-ask spread? I think that it's appropriate for the deals that are on the market, but I think there's such a lack of product because sellers still are looking in the rear view, as Brian said, for, first half of 2022 pricing, and they're holding out there. Now, one newer development I think that we've noticed on the the bidding front, and especially in these marketed processes, the rise of the unlevered buyer. Traditionally, we would run into these groups, if we were looking at an asset, maybe 13 to 15 million, which is about as low as FNRP will go on the deal size. We've been now running into groups upwards of 20 to 30 million buying all cash, which is a new concept that we've at least been seeing. And I think that's really just a function of the scarcity of product on the market right now.
Yeah, great. Thanks for that. And then moving over to multifamily, I can tell you from a 10x viewpoint in terms of deal velocity, that's we've seen a huge drop off on multifamily. And a big part of it is we just don't see seller expectations lining up with what market pricing is. And Chris, love to get your insight on that, because it seems that a lot of owners, sellers are looking at price per unit, and they don't really want to budge a lot from where comps have historically been over the previous times.
Yeah, I would agree with that sentiment. I mean, look, there was a large pause in, say, early mid 22 to sort of when the activity started to happen with the rates. We started to see a lot of interest from buyers starting in early 23, and then sort of mid 23 is when deals started to happen and that bid ask started to close. And to Matt's point, I think really what happened was a lot of the tire kickers, if you will, kind of exited the market. Brokers stopped putting ridiculously priced assets on the market because the stuff was just sitting. And so we're seeing now a lot of market sellers or creative sellers where they're holding the financing, and that's also starting to really help close that gap. But everybody's feeling sort of optimistic and / hopeful, more hopeful than JR is indicating. Towards the end of the year, we'll get back to business. But I would say that it was very large, almost 30% at the beginning when the rates really started to go on. But now we're starting to close and we're getting deals done.
Excellent, excellent. And obviously, bid ask also impacts net lease in a big way, and what's going on there. Camille, love to see what you're seeing specifically on these stabilized deals, especially long-term 10, 15-year leases, or is there still a lot of interest and activity?
Yeah, and I was just sending you a note to mention Walgreens in particular, because I realized as I'm listening to everyone else talk, that I left that out. I would say I don't have much new to add. It's very similar to what other folks, especially Matt, was reflecting. I think we have folks who have generational needs to transact, and they are transacting. But right now we have a family office that's dividing just generationally. They've hit the moment where they're dividing into 2 family offices, so they need to get sell some assets. Again, those kind of things come into our space quite a bit, or something tax related. Like we're doing a ton of car wash transactions, and I would expect that to be a big driver in Q4, especially if the bonus depreciation goes back to 100%, which we're sort of waiting to see what the Senate does. Regardless, I think there'll still be a lot of activity around car washes and convenience stores in Q4 for that tax driven reason. I mean, everybody's death and taxes. We can't avoid these things, right? Like we're still working on those no matter where all the interest rates are. But we do have some additional drivers in the space, and I'm watching to see how this is going to fall out. But Walgreens, we've seen a downgrade in credit recently. Went to BBB, and then shortly with the S&P, and shortly after that, Moody's took it to a Ba2, which is basically junk status. We've been watching that and wondering if the owners would care. We didn't see a lot of concern. I think there was actually more concern over having no escalations in a classic Walgreens lease in this inflationary environment. And so those 2 things combined, we're like, gosh, what's going to happen? And yesterday, for the first time, an owner called us, and Wells Fargo had begun a cash sweep because of the change in credit. And so that changes everything, right? When the owner is in that position, then they're going to transact. So I think everybody on the phone who has anything to do with net lease or retail and has Walgreens in their portfolio, I think there's significant price changing that is not even cyclical, price changing that is happening with Walgreens. And I think we're going to see that with other groups that have been impacted by this economy at large and have been the darlings, like Walgreens has been a darling for a long time. So there will be some changes coming out of the cycle with net lease. As far as bid ask goes, I would say we're settling in, but these are still surprises.
Yeah, great. As we get to wrap things up here, and I'd like to stay with you, Camille, to be the first person to answer. This is just a quick roundtable on, fast forward 3 years. We're at the end of 2027, going into 2028. What's your prediction in your asset class, net lease?
My prediction is that interest rates will drop substantially. I mean, the Fed rate has to go down. People much smarter than me are of the opinion that we can't afford our own debt as a government. So there's sort of no way that we can sustain, the rate being in the 4s. We're going to have to get into the 3s, maybe low 3s, maybe even lower than that. Love it if it could be in the 2s. And at some point we get a delta that's really nice and healthy between the debt constant and the Fed rate. If you look at the data, for the younger people on the call, it's a myth if you think those things are actually tethered. The data will show you it's all over the place. We're actually fairly close right now. So it's hard to dream that it would get closer. So we've got to have some movement in the Fed rate for anything to substantially change in cap rates. But I would say 3 years from now, I mean, in the modeling we're doing, especially because we model around 5 years, like many of you do, we're thinking cap rates are going to be back closer to a 2019. So it's sort of the year we keep going back 5 years to look ahead 5 years.
Awesome. I see, Brian, you're nodding your head. So capital markets, what do you think is going to be 2027, 2028?
I think that was a very succinct and astute statement, that to look ahead 5 years, look back 5 years. And there's look, the residual cap rate is always a big part of the IRR and everybody's belief. And that's also plays into, where we are in cycles. And there's a lot of debate of, are we ever going to see 2021 cap rates again? In the e-commerce and the multifamily and whatever, asset class you want to talk about. And then it reverts back to, we had settled into cap rates in 17, 18, 19, when you had treasuries that were in the low 4 to 4% range. And that's, when you read the predictions, that's where we're going to stabilize again. So I'm a believer. Let's look back 15, 16, 17, 18, 19, and that's when I'm averaging my data to make support, whether it's myself or in the advisory business, to say where are the long-term trends on the cap rates. And I think that's where we should fall back to.
Great. Matt, on the retail side, what do you predict, whether it's concepts, the way people shop, the way your anchor tenants function?
I'm a little more concerned about the next couple months here instead of 5 years out, but and figuring out what the rest of 2024 is going to look like. I know, Camille, you mentioned hopefully Q3 and Q4 are a little bit more active. I appreciate your optimism. I'm not quite as there. I think just being an election year in November, I'm worried that there will be some sort of market freeze when everyone's going to just want to wait for the results of that election. So. But hopefully following whatever happens there will bring some stability. And I do believe that rates will start to come down, hopefully significantly. But I think more importantly, whether they would come down a lot or a little or stay where they are, I think the lack of volatility in the market is going to breed more deals. And I believe that better days are ahead of us. I think we probably are going to have to grind through 2024, much like we did the second half of 2023. But I would anticipate over the next 2 to 3 years, deal flow to pick up immensely. And the last comment I would make about it too is, just going back to, the pandemic in 2020 and 2021, when a lot of these deals were being cut with tenants, lower rents for additional term, maybe deferred rents. And we're seeing a lot of those deals, COVID deals, start to burn off, in 23, 24, 25. And we think that there's going to be a lot of upside there. So we think from a leasing standpoint, the market's going to remain strong. There's going to be a lot of competition. I don't expect, construction costs to plummet and, anytime soon. So I think that's going to give rise to a strong, healthy leasing environment as well.
Excellent. Thanks.
I just want to
Chris,
make one correction. Sorry.
Yeah, please.
I stated that back in 16, 17, 18, the treasury rates were, 4 to the low 4s. Interest rates. Treasuries were in the mid 2s. But the interest rates were, in the low 4s. And that supported a lot of 5-cap transactions in multifamily, mid 5 caps and grocery anchored retail. Where were, the single tenant pharmacies and other credit rated retail pads trading at that point? Weren't they mid 4s to 5 as well? Camille? With that.
Mid 5 cap rates, Chris, sound very aggressive for multifamily. Are we going to get back to cap rates in the 3s for multifamily fast forward? What do you think?
I think that investor demand is going to remain very strong for multifamily asset class. I think this metro market, okay, where a lot of the development has happened, we're in the top 20 of major metros, right? Dealing with rising tax and insurance costs, everybody understands that scenario. If the developers can get everything built, right, which I think may be contingent upon how the financing and money markets continue to look, right? They need to keep their jobs going. If they can get everything done, statistically it is Q1 26 and Q1 27. We were going to have very large deliveries, much larger than we've had, right? So there's still going to be a lot of product to work through, but it's going to be challenging for developers, but demographically, it's not going anywhere. There's still too many people, and it will take some time to work through that product. But in 5 years, this metro market, in my opinion, multifamily is a place to be, and it's a safe place.
Yeah. Thanks.
Ian, if I may add to what Chris is saying,
Sure.
since multifamily is the driver of everything, you guys, 421A in New York, although it may not be 421A because it didn't get passed in this last legislature session, but I believe the governor is working out an alternative to 421A, which is basically the tax abatement program that allow developers for multifamily that are building a certain amount between 25 to 30% to be affordable. They're going to come up with a new plan, and I believe it's close to getting done. That could be some optimism and hopefully drive the multifamily sector in New York and get the development back on track again, which will, I think, add additional supply to the market. There's a lot of pent-up demand. Deals have been approved, but not getting out because of the financing, of course. But I think that the 421A or version of that will be a way to kind of get new product out and hopefully relieve that space and bring on new supply, which will then help lower prices and get new product out.
Oh, that's great. And just to wrap up with you, JR, because we're right at an hour, and then I'll turn it back over to Lee to see if we have any Q&A. And for anyone watching, please send your Q&A through the chat. But JR, your predictions for financing in 3 years' time, what do you think will be?
3 years, just like what Brian and Matt and Camille, everyone echoed here. We could be across the board. Are we stabilizing? Do we see to have the exuberant optimism of Camille, or do we see some skepticism as we see in Matt, not sure where the market is going? It's really, I don't really want to say it's a function of rates so much as, again, I go back to motivation. What's the seller's intention? They got to sell because it's maybe they have to remand money back to the fund, and they're going to do a 1031, and investors need their money back. So if they're going to sell, they're going to sell. So the question becomes price discovery. Are we at a point where rates are going to be where they are, or are they going to be lower? I think it's going to get create a lot of creativity in getting it done. So since financing is a big part of it, potentially deals are getting done with cash, with more family office money, and that being said, it could be possible, but if it's not, then we're looking at some sort of debt, senior debt coming in and layering that debt with whatever equities that the buyers are coming in with. There's always going to be a gap, and that gap is going to be filled. That mezzanine piece, however that's created, whether that's done off balance sheet financing on the lender side, or whether that's done on the buyer side to come in with the additional cash, or it could even be with the seller carrying back more paper to allow that to happen, an installment sale. Again, deals will get done. It's just a matter of how they're going to get done. It could be the seller, the bank, the buyer. It could be any three of those combinations to create the solution. I'm not saying it's one or the other, but it could be very many. And you have to think dialectically. As a CCIM professional, our mandate is to use the tools that were given to us. At the same time, communicate. I heard earlier, Camille mentioned communication. Communication is key and vital to this marketplace, not only among our peers, but also with the sellers and the buyers and the bankers. And everyone working together, I think, is the best way to get accomplish and get a deal done. At the end of the day, always be closing.
Yeah, great, thanks. So I do believe we have some questions in the chat. I'll turn it back over to Lee Barnes. Lee, you're on mute.
Thank you, panelists. This question is from Karen Hurd. Curious how rising insurance costs are impacting real estate portfolios and your perspectives.
I'm going to pin this over to Brian. He's nodding his head, and I know he's active out there on the acquisition side. Brian, you want to, on multifamily, you want to take a stab at it?
I will. Look, taxes used to be one of the biggest unknowns in the acquisition or dispositions, and now it's become insurance, and more so the rising cost of it. We're seeing it anywhere. It can be 2 times to 3 times what it was go back 5-6 years ago. And so look, we can with this. So to answer your question, is it impactful? Absolutely. Has it lowered values? Absolutely. And let's also get into the bid-ask spread, right? So the sellers have historically been operating on one set of expenses, and the buyers are saying, now that I have to go out, I got to get a fresh policy. The insurances, rates are literally doubling to tripling, or there's been situations where on the acquisition side, it is very hard to find a policy if there is significant losses on a property in the past. The markets are just not that deep for it. So that if you had to ask me the top 3 things that are impacting values and transactional activity right now, it's definitely top 1 to 2, taxes and insurance.
I would love to chime in because I think it's worth noting that it should impact values in net lease, and it should make people not want to invest in Florida, for example. And it's not. It's not that topical because it goes to the tenant, right? Not directly the owner. Does it ultimately have an impact on the value of the asset? Yes. But I'm just saying, in the streets, not being discussed, not impacting values.
So it's, I guess on the net lease side, it's being absorbed by the tenant, and at some point they're taking it as a cost of doing business. But when is it gonna, and how high does it get before it circles back to the landlord and rent deflation?
Yeah, right. Thanks for that.
All right, the next question that came in was from Christopher Correa. Thoughts on AI in CRE?
Anyone want to take a stab at that? I could tell you yesterday, I searched ChatGPT with a specific question, and the Mr. or Miss GPT response was based on 2022 data, and I'm like, come on, let's go. So I would just make a general comment about AI because I know everyone in commercial real estate space is using it in some capacity. Trusted advisors, it can give you a great foundation for marketing materials or to get insight into a specific area. My personal advice on the AI side is use it as a foundation, but absolutely fact check and put your own personal input and experience on it because it's only as good as what's going in. But I see a lot of other benefits in AI and data. And, Camille, I've always felt you've been on the cutting edge on the data side. So anything, in terms of what B+E is doing on the AI side?
The first thought I had was not actually about B&E, but we've been using AI, and it machine learning grows over time, develops, and will help all of us. And I think all of you are using it through various applications without being mindful of it today. Will it take over all our jobs as advisors? Not real soon, but at some point, could that eclipse? B+E stands for brokers plus engineers. It's a bet on human plus tech. So the most senior people are going to stay with the best technology, just like your surgeon. It's very what we do is very comparable to healthcare. So, but that's not the first thing that came to mind. I do think it's probably worth noting that as NAR is in trouble, so is their venture fund. And I just spoke with Laura Millichap about this a few days ago. And I'm not going to share anything that would be confidential or really earth shattering, but you can look and just see that would damage technology companies within the resi space especially, and that will trickle into our space.
Thanks.
Laura is a principal in that venture fund. That's why. Yeah.
Got it. Lee, one or two more.
Yeah, this question is from Linda Martinez, and this is directed at you, Ian. What are you seeing as the hot asset type at 10X in Q1?
Yeah, thanks. Thanks, Linda. Glad you've joined us. So we started out this year quite surprisingly with a lot of activity. We're in the process of an auction today, but so far in Q1, we've sold close to 200 million of assets. With a 52% trade rate. For anyone who is a baseball fan, a 520 batting average is not too bad. Number one selling asset class has been office space, office buildings. We've been a lot more selective on the assets we're bringing to platform in terms of seller expectations, but I think that's the one asset class where we've seen the sellers really come to reality on what market pricing is. And to put things in perspective, we have on live bid auction, sellers come with a minimum undisclosed reserve price that they're hoping to achieve. Office buildings have seen the greatest flexibility on pricing. Our office owners have flexed 13.4% off what their minimum undisclosed reserve target has been. And then in terms of the next most popular asset class on the platform is retail, then hotels, industrial. We always do great, but there's not a lot of industrial product on the market. And the biggest 180 we've seen has been multifamily. We have an auction going on, which ends today, just to put things in perspective. 260 million of product, 47 properties. Average asset size is 5.5 million. So we're seeing real interest, and our trade rate as we speak has pumped up to 62%. So that says a lot in sellers meeting market pricing and getting true price discovery.
Any hotels, Ian?
The limited service hotels, Camille, lot of activity in that area. And across the board, we average about 130 signed confidentiality agreements per deal with 10 fully approved bidders. The numbers on hotels, especially limited service hotels, substantially higher. There's a lot of capital ready to deploy for hotels, depending on, what specific markets you're looking at, and where there's not oversupply of inventory.
And
Lee, I
Ian,
think we have time for one final question.
Yeah, I just have, Ian, this is a question for me. I just wanted to know what activity you're seeing with 10X live bid auctions.
Yeah, right along the line that I was saying is in real time. That's one of the things I really like about live bid auctions is it gives you a pulse as opposed to appraisals, right? Which are going back, 90, 120 days. Our appraisal is today. You know what your property is worth today. And I'm very optimistic, and it's primarily because of our expert panelists here and the feedback that they've provided. And I'll wrap up by saying, just based on my 25 plus years of experience, it takes about 6 months for markets to get better once people really start speaking about positive aspects of the market. And that's not to say to sugarcoat what's going on, but I think everyone who's on this panel and participating, we all live with the glass 10% full, right? That's why we do what we do. And there's always something positive you can take away from the current market. So I really am, optimistic. I know there's going to be a lot of things impacting what's going to happen in the CRE space, whether it's rate cuts, we got an election coming up. But when I look around at my peer set, I know that they're all going to be very successful. And for everyone on this call, please use us and CCIM Metro as a resource. So thanks for that question, Lee. And any other questions which we haven't gotten to?
I'm gonna. Ruth Wang has a couple questions. I'm gonna give a chance to answer one of these questions. What's your vision for the future of those long vacated retail stores and office space?
Matt, if you want to take that, and then I would say, Lee, any other questions which haven't been answered, just in the interest of time, we'll share the questions to the panelists, and in the follow-up that we send out to the participants, we can answer those questions as well. So Matt, if you want to bring us on home with, I know you don't have a lot of retail vacant space, but if you can share that.
So vision for future of those long vacated retail stores. So yeah, I mean, again, the retail leasing market has been pretty strong. We don't have a lot of centers, personally speaking, that have a lot of longstanding retail vacancy. That's something we evaluate during the acquisition stage, and we'll underwrite accordingly for if we think it's structural. But I think the entertainment uses that I touched on earlier are generally good fits for larger spaces that otherwise would have been structural, like maybe a large, possibly like a basement space. Fitness users could take, back of center space as well. That's something we're always considering. You could put the CrossFit guy in the back of the center. Don't necessarily need frontage. Office space, not really something that we're too bullish on. As Ian touched on, office landlords have been the most willing to cut their reserve price in order to get rid of their assets. So I don't think that they have a lot of faith in the long-term, profitability of those those assets. I think that ultimately it would take significant, redevelopment dollars to repurpose those office spaces. And there are groups out there that are looking for exactly those opportunities to buy these distressed office buildings, to repurpose them into mixed use assets, not necessarily a primary focus for FNRP though. So hopefully that answered your question. And I just wanted to thank everyone for the time, and it really was a pleasure. I enjoyed the conversation.
Thanks everyone. Thanks Lee.
Yeah, thank you.
And,
thanks everyone for joining. This is the first webinar we're going to have in a series of 4 different webinars throughout the year quarterly. So stay tuned. Obviously, the panel, the people that had those questions that we weren't able to get around to, the panelists will certainly get back to you with any answers on those. Thanks again.
Thank you, guys.
Take care. Thank you, everyone.